Hello, everyone, and welcome back to another episode. I'm your host and millennial investor, and today we're going to go over my dividend growth investing strategy. And the reason why I love this strategy so much is that when I tell people on the street, when I'm telling friends and family members about the way that I invest into my companies, is that I describe it as the quadruple income strategy. So if you're new to this strategy and you haven't seen anything about it before, I will show a few in-depth pieces of information that is very important and hopefully try to convince you to use this strategy yourself. So what we'll show in this video, I will show as always, I will show my four charts that track my annual dividend income, monthly dividend income, portfolio value, and my monthly YouTube income, as well as show a bunch of my portfolio highlights like my passive income, the amount of checks, the amount of dividend checks that I'll get every single year, the dividend range in my portfolio, the four different ways that your income will be allocated towards you in this investing strategy. And then I'll also show a few other different things. I'll show the 26 stocks that I currently own, my investing pie, 3-in-1 Finance, the brokerage that I use, but I'll also show something else. What we're going to do is that we're going to look at a compound interest calculator, and we're also going to look at a back test portfolio allocation tester. So the first one I'll show, I'll go ahead and give a little teaser. If you're starting with $100, that's what you need to get started with M1 Finance. If you have $100 right now, and I'll use the example, let's say you're 30 years old. So if you contribute $500 a month, if you can come up with $500 a month, no more, no less, just invest that amount every single month like clockwork. If you're 30 years old right now and you invest for 35 years, okay? 35 years, you'll be 65 years old when you get to retirement age, and you're getting a 10% interest rate. Now I'll show a 2% interest rate variance range in case you get 8 to 12%, and compound monthly. When you retire, if you're 30 years old, investing $500 a month, you will retire somewhere around $1.9 million. And this is the range of what it would look like best and worst case scenario, with a variance range below 1.1 million, 1.9 on average, and then 3.2 best case scenario. But you can see how investing is an incredible strategy, and I have the belief that a dividend growth investing strategy will outperform that of the market and is best suited for that of a person that is wanting to retire off their income. So thank you guys so much for tuning in. I would invite you to subscribe to the channel if you're new to me. My name is Jordan. I'm the Millennial Investor. And one of the ways you can get signed up and go ahead and get started investing with this strategy is, like I always mention at the beginning of the videos, if you like the brokerage that I'm showing in this channel, this has no brokerage fees whatsoever, no commissions, no type of annual fees, nothing like that. And we have 56 people signed up. So if you want to use this link, it is down in the description, as well as check out some other things as well. Like I have mentoring calls if you want to help get set up with your investing strategy. I have mentoring calls down below, as well as other things like high yield savings accounts, credit card referrals, other things like that. But here's the 26 stocks that I currently own. And like I said, the pie will also be shared down below in the description right here. But go ahead and get started. Let's look at my portfolio highlights. My portfolio highlights are $264 a year in passive income. So my portfolio, as of today, this gets updated every single month, but this is my annual dividend income, this main chart right here, the first one that you see. If I were to go to sleep into a coma and then wake up 10 years later, my portfolio would be growing its income every single year because of dividend raises and dividend reinvestments. But as of today, my portfolio makes me about $264 a year. This is money that I don't have to work for. This is money that shows up no matter what. When I fall asleep on my pillow, I'm going to make about, what is that, about 75 cents every single night that I fall asleep on my pillow. So that is incredible, and that works out to be about $22 a month that I get to reinvest back into my portfolio that I absolutely have to do nothing for. I have 26 different dividend stocks, and this will work out to be about 112 dividend checks a year. So if we go to my activity feed here, and this is why I love the dividend growth investing strategy, is that if we sort by dividends only, and we look at my feed, you can see that the constant dividends is just constantly rolling in, non-stop dividend payments, and you can see that they're steadily going up. So one of the examples that I always love to give an example of this is the only monthly payer that I own is Realty Income. It went from 60 cents to 70 cents to 71 cents to 83 to 95 cents to $1.42 to $1.90, and now I know this next month should be somewhere around $2 and something cents. So you just see how it's a steady climb up, and I'm getting more and more shares of Realty Income. And now with Realty Income, I now own about 9 shares when I only started with about half a share when I first started this portfolio. But going back here, yes, that 112 checks a year works out to be almost about 10 checks a month. It's about 9 point something checks a month, and that steadily increases my dividend income as well as my overall portfolio value. Now, the dividend yield ranges widely in my portfolio. What's great about this portfolio is that you get to have a mix of both the good and the bad. If you want a lot of very low yielding stocks that only pay out a little bit in dividends. In my 8 or 9 months that I've been investing, Visa has only paid me about $1 in dividends. That's hardly anything. But if you look, the share price has increased dramatically over the years and over the months that I've owned this company. But if we look at other stocks, for example, and then my highest yielder in the portfolio is Altria. Altria has been raising its dividend for a long time, and it consistently pays its dividend even at an 8 and 9% dividend yield. So if we go back to my portfolio, you see that you have a lot of different mixture of stocks in all different sectors, from consumers to technology to telecommunications to all different things. And my portfolio gives you a broad range of what it should look like when you're retired on both a dividend growth strategy and a high yield strategy. But let's go ahead and look at the first way that you receive income with the dividend growth investing strategy. And the first one is share price appreciation. Blue chips tend to gradually go up. They're some of the best businesses on earth and grow revenues almost every single year. So let's go ahead and look at some of the blue chips in my portfolio. And a lot of these stocks I never intend to sell. So I'll look at a company that's been raising its dividends for 50 plus years. Let's go ahead and look at Pepsi. Pepsi is a stock that is a beast of a company. If you're curious right now, if you're watching this video and you say, Jordan, maybe I already have a lot of money to invest, or even if I don't have a lot of money to invest, I'm scared of losing my money in the stock market. Well, I want to ask you a question. Have you ever drank a Pepsi product? Have you ever ate a Pepsi product? Have you ever ate a bag of Cheetos? Have you ever ate a bag of Doritos? Yeah, here's a bunch of their brands right here. Have you ever drank a Pepsi? Have you ever drank a Mountain Dew? Have you ever drank a Gatorade? All these different brands are owned by Pepsi, and basically you can make the assumption, if you like some of their products, would it not be safe to say that millions and billions of other people probably also like their products? Well, if that's the case, Pepsi is going to continue to sell beverages and snack foods to pretty much everyone on planet Earth, and they continually find ways to grow and expand their brand and get a new line of products every single year to increase profits and pay out more dividends to its shareholders. And that's how they raise its dividend every single year like clockwork. And it's already raised at about 7% this year. Now, the cool part is we like to talk about dividends, but look at this share price. Just in the last 5 years, it's went up about 40%. It went from $100 a share up to $144. But that's not all. Let's look at some other blue chip stocks out there. Let's look at another one. Let's look at Johnson & Johnson. Over the past 5 years for Johnson & Johnson, you've seen some great share price growth as it's went from about $100 a share again, same thing as Pepsi, and once again to about $143 a share, about a 40% increase over the last 5 years. Let's just look at one more example just to give you guys an idea. Let's look at one that's had some great growth over the last 5 years. Home Depot is a stock that not only pays dividends like crazy, but if you see 5 years ago, this was a $130 stock, and today it sits at $273. That's over 100% increase in the last 5 years. So investing in Home Depot, not counting your dividends, you would have already doubled up your money in the last 5 years and then some. So this is why investing in blue chip stock is great, because the management teams are some of the best in the world, the businesses are the best in the world, and they continually increase in share price in the long run. Now, one thing I do want to mention, just when we look at any stock, when we look at, like, for example, the S&P 500, stock prices do fluctuate. They go up, they go down, and there's no telling where they're going to be 6 months from now. But generally, in the long run, like you see this big spike down here, in the long run, they pretty much always go up. So I wouldn't be too worried about the share price, but it is one of the benefits of this investing strategy. Now, income source number 2 is the most obvious and the one that I talk about a lot, which is the dividend income. And the reasons why I love the dividend income is that it is a constant straight line up. When you look at this share price, right? This is the S&P 500. It is up, it is down, it is up, it is down, it is up, big spike down, big spike up. It is all over the place. But when we look at my specific dividend income, it is up the next month, up the next, up the next, up the next, up, up, and away. It never goes down. And when you're investing for dividends, when you're focused on your dividend income, that is usually what your chart is going to look like. About 95% of the time, it is always going up. Sometimes it's a little bit higher than others, but it's basically going to look like this chart right here. Now, if we go back and we look at the other main 3 bullet points that I have for this, is that profits are shared with the owners, the shareholders, which is you. So I think a lot of times people forget when you buy these companies, let's say, for example, you want to buy Realty Income. If you go out and you spend $62.90 and you own 1 share of Realty Income, you are now a owner of that company. You are entitled to the profits. You are entitled to vote on the board of directors and other proxy materials. You are a legitimate owner of the business the same way as if you were to get $1 million loan and start your own company. You are a legitimate owner of Realty Income. It's just a really small amount. Now, the beauty of this with these blue chip stocks is that a lot of people are doing the same strategy as you. I am not alone, and there are billions of dollars being circulated every single year, and they're doing the same thing that I am. And that is that many shareholders reinvest their dividends, which further supports appreciation. Now, the cool part about this is that even if companies do not increase revenues, even if they do not increase profits, a lot of shareholders, when they receive their dividends, reinvest it right back into the company. And that's why when you see these blue chip stocks, not only are they growing their business models, but so many people are buying their stock over and over and over and over again every single quarter, every single year. That further leads to higher share price appreciation. So once again, it's a win-win strategy. And then third, and last but not least, dividends are the best allocation of capital. So when you look at these companies, like for example, let's go back to Pepsi. Pepsi is one of the largest suppliers in the world for food and beverage products, and they supply food and beverages to billions of people out there. B with a billion. And they have so much money, and their business is so profitable that the best way that they can allocate their capital is to give it back to you, the business owner. It is not to fuel through other poor acquisitions that might hurt the company. This is the best way that they can fuel their growth. Increase share price appreciation through paying back dividends to shareholders. So that is income source number 2, dividend income. And let's go ahead and get to income source number 3. And of all these strategies and all these different income sources, I think number 3 is the most exciting, okay? Income source number 3, annual/quarterly dividend raises. Now, when we look at these companies, let's go to Coca-Cola. Coca-Cola is one of the main blue chip stocks in my portfolio. Let's look at the dividend history for this company. This goes back the last 5 years. 5 years ago, they paid 33 cents a quarter. Okay, fast forward, then they paid 35 cents a quarter. A year later, they paid 37 cents a quarter. A year later, they paid 39. A year later, 40, then 41. And then here in the beginning of 2021, they're looking at raising again probably to 42 cents. But you see, not only is the share price gradually going up, and not only are you getting dividend payments, but the payment itself is continually going up a couple percent each year. Let's look at one that's a blue chip stock that's growing a little bit faster. Let's go ahead and look at Johnson & Johnson. They typically grow their dividend a little bit faster than that of a lot of other blue chips. Johnson & Johnson, let's look at the 5-year chart. 5 years ago, they paid 75 cents. The next year, they paid 80. The year after that, they paid 84. The year after that, they paid 90, then 95. And then here in 2020, they raised it up to $1.01, and I'm sure we'll get a raise in 2021 as well. But this company not only has a great yield, but continues to raise its dividend 5, 6, 7, 8, 9% every single year. And the way that these companies make it happen is at their bottom line, the profits, the net income, the cash flows, all increase gradually over time every single year. And what's important about this is that this is a great opportunity as a shareholder to see that the management team is committed to maintaining its dividend streak. A lot of these companies have been paying its dividend 20, 30, 40, 50, 60 years in a row, and they have raised that dividend every single year. So these companies, even when they hit hard times, continually find ways to increase the dividend and come up with the money to pay its shareholders, because a lot of people rely on that income to invest in the stock market. Now, management teams are committed to maintaining this, and when you have stable blue chip stocks like this, they pretty much increase it no matter what, unless it is the absolute no other choice. Cut the dividend and try to survive, but other than that, they pretty much pay their dividends no matter what. And something I really quickly want to mention here is that when we look at a lot of these companies, and Coca-Cola is a perfect example of this, some of these companies in my portfolio, like Procter & Gamble, Coca-Cola, Johnson & Johnson, some of these stocks were paying dividends in the Great Depression. Yes, you heard that right, the Great Depression in the 1920s, the 1930s. Now, some of them have continued to pay dividends throughout the Great Recession 10 years ago in 2008, 2009, but some of these stocks were paying dividends in the Great Depression almost 100 years ago. So just keep that in mind, and this shows you how safe and stable a lot of these investing strategies are. What's more important about this is yield on cost becomes incredible after years/decades. So I'll show you an example. Let's go ahead and look at Home Depot. I said that's one that's been a really high grower over the last couple of years, and I expect this to probably continue. And I'm looking at bumping up Home Depot in my portfolio. I may be considering it. But okay, let's go ahead and take the dividend payment, which is $1.50 a quarter, which works out to $6 a year. So you take $6 and divide that by the share price, which is $274. That gives you a dividend yield of 2.18%. M1 Finance is just a little bit off. It says 2.14. It's actually 2.18. So if you were to buy a stock in this company today, you would have a 2.18% dividend yield. Okay? Now let's go 5 years ago, and let's say you bought at $135 a share. Based on your yield on cost, you would be buying shares back then for 135, but today it's paying $6 a share in dividends. So take $6 a share in dividends, take that in your calculator, take 6 divided by 135. That means as of today, your yield on cost for those shares you bought back in 2015, 2016 would now be paying you a 4.44% dividend yield, almost a 4.5% dividend yield for not only an excellent paying company, but a company that has doubled in share price. And you can see very quickly how a company like this makes people very, very wealthy. Just for fun, let's pause the video real quick and let's show an opportunity here for investing in a blue chip stock that explodes in share price, has incredible dividend raises, and show you what it will look like on a long-term chart. Now, these are real numbers going back 35 years. You know how I gave you the opportunity for investing in $500 a month for 35 years on a 10% interest rate? Let's look at how this would look for Home Depot. Once again, starting with $100, investing $500 a month, going back 35 years to 1985. Let's look at if you were to invest Home Depot $500 a month every single month. Let's look at how this would look going back to 1985. Let's click Analyze. And if you were to do that here in 2020, you would cash out somewhere around $20 million. You heard that right. $20 million. Home Depot has been one of the best performers, having a money-weighted return of about 20% a year. And now this is pretty unrealistic, and I know you will probably never get these returns, but this just shows you a power of a company that has excellent management, excellent share price appreciation, and excellent dividend growth. This is why the dividend growth investing strategy is the quadruple income strategy. And going back to this brings me to my number 4 bullet point, is that the income source number 4 is the acquisition of new shares. Now, when you get these dividend payments, here's what's so key here, is that you should not look at getting these dividend payments as cash. You should look at getting these dividend payments in the form of extra shares. So I want to give you an example, okay? Let's say that you're buying Coca-Cola stock, and let's say you buy it for $41 a share, okay? This will just make things really simple. And let's say you buy 100 shares of the company, okay? So if you take 100 and you multiply that times 41, okay? 100 times 41 is $4,100. You will get a dividend payment of 41 cents every single quarter, okay? So you take 100 times 0.41, you now have $41 you'll get every single quarter, every single 90 days. Now that $41 can buy another $41 worth of shares, which is about a full share. So you now have 101 shares of the company. And then the next quarter you'll have 102 shares, and then 103 and 104 and so on. And this is how this makes this portfolio explode. Not only are you getting those dividend payments that go up every single year, you shouldn't look at it as cash in your portfolio. You should look at it as free shares. You're getting free shares just to be an owner in this company. They're saying, hey, you want to own more of the company? Well, here you go. Here's a free check to buy more of it. And the best part about that is when you get those, quote, free shares, the reinvested shares also receive future payments and raises. So when you buy those Coca-Cola shares, when the example that I gave, when you own 100 shares and you now own 101, well, guess what? That extra 1 share you just got also gets dividend payments. The extra share you get the next month also gets dividend payments. Oh wait, next year they raise the dividend? Okay, well that also gets dividend raises. And that's what fuels the fire to this strategy. And then the regular deposits, in the example I gave with the $500 a month invested, continually acquires new shares, gets additional payments, gets an additional raises, and also gets benefits from the share price appreciation over time. Now, thank you guys so much for watching, and I wanted to show one last final example here. Now, I show this all the time. I've showed this before. An example of a bunch of blue chip stocks. Just taking 10 of some of the most high names out there and just investing in 10% each. Take the top 10 names and see what it would look like over a 35-year period. So let's just take some of the top 10 blue chip names in my portfolio. Okay, let's go ahead and take Home Depot. We'll take Johnson & Johnson. We'll take JP Morgan. We'll take Coca-Cola. We'll take Pepsi. We'll take Procter & Gamble. Let's take, what else? Let's go ahead and go back to my portfolio. Let's see what else is in here that are a bunch of blue chip stocks. Let's go ahead and put in 3M. 3M is one that's been paying a long time. We'll put in 3M. We'll also put in KMB, Kimberly-Clark, and then let's put in, put in the wrong one there, Kimberly-Clark. Okay, and then what we're going to use for the last two, we're going to use Caterpillar. We're going to use Altria. I forgot Realty Income only pays its dividend for the last 25, 26 years, so they don't go all the way back to 1985. So I picked companies that have all been paying dividends since this time. raising it every year and going all the way back to the last 35 years. So these 10 companies, Home Depot, Johnson & Johnson, JP Morgan, Coca-Cola, Pepsi, Procter & Gamble, 3M, Kimberly-Clark, Caterpillar, and Altria, if you were to invest in them for 35 years at 10% each, you would end up with $5.6 million. This is the number right here, with an average money weighted return of a little over 15%, a time weighted return of almost 17%. You would have a fortune, and this is only investing $500 a month. Now I'll show you one last example. Let's say that you didn't have $500 a month. Let's say that right now you only have $200 a month. I know that's a lot smaller amount, but I think a lot of people could manage to invest only $200 a month. That's not a lot of money, okay? If you were to do this and you only had $200 a month to your name, you could still end up with 2.2 million 35 years later. And this is why investing not only in companies, but investing in dividend growth companies, in my opinion, will beat the market and how you can get these incredible charts to look at over the next couple of decades. But thank you guys so much for watching all the way to the end. I invite you to subscribe if you haven't done so already, and go ahead and check out this referral link to mentoring calls, to M1 Finance, to credit card referrals, to Yada savings accounts, all that stuff. Check that out down below, and you can follow along with me and watch my channel and show you why the dividend growth investing strategy typically takes my stock chart pretty much nothing but straight up. But thank you guys so much. I'll catch you guys next time. Peace.